The Solomon yield engine has finally been kickstarted, routing yields across the Solana ecosystem to hundreds of individual DeFi wallets. Welcome back, guys, to another episode of On-Chain Trenches and another deep dive video into Solomon, the yield router of the Solana ecosystem. In today's video, we're gonna break apart the yield engine that Solomon has created. We will double click on YaaS, which stands for yield as a service, and how it can be applied as this generalized yield router that distributes yield across the entire ecosystem. Furthermore, we will talk about the yield optimized treasuries, how you can use the USDv stablecoin, Solomon's native stablecoin, to earn yield on your treasuries. Later on, we will talk about the Solomon buyback proposal, which will go live soon, and implications that might have for the Solo token, before we then conclude this episode. Taking a look at the Solomon roadmap that 𝗟𝗲, the CEO, just shared with us, outlining their vision and everything they're working on over the next 6 to 8 months. So without further ado, let's directly jump in. Just a few weeks ago, 𝗟𝗲 here, the co-founder of Solomon, he released Lab Notes number 5, which is a monthly update where they share everything that's going on in their ecosystem and what they are currently working on. So here is a short summary. First of all, finally, YaaS, the yield engine, went live and is now delivering yield, especially for 𝗟𝗏, and their LPs, they are currently earning 22.6% API on their liquidity, and more on that in a second. And since this liquidity pool went live, we saw a 3.5x pool growth, and the launch of yield as a service was also featured in CoinDesk research. Furthermore, on the engineering and security side, they have seen a lot of momentum, and they have especially hardened their backend with 300 plus commits across 8 repositories, and the long-awaited audit from Cantina was cleared with no major issues or bugs found. And another exciting news is that USDv, Solomon's native stablecoin, is now finally integrated with Jupiter. This means that you can now swap in and out of USDv with 0 extra routing fees using Jupiter, and this is key for the proliferation of their stablecoin going forward. And then towards the end, he shared what's next for the protocol. They outlined 2 specific proposals, which we will discuss in a minute. First is the Treasury action, where they will try to convert part of their USDC treasury into USDv so that the treasury can earn passive income, extending their runway. And then we will talk about the Solo buyback proposal. And 2 key blocks of their roadmap are the expansion of YaaS, again, yield as a service. They are offering it to neobanks and institutions that are just around the corner entering crypto. And finally, he teased a major Solana announcement that should be dropping soon. Now, let's unpack the recently announced partnership with 𝗟𝗏, which is the first DeFi protocol that opted into yield as a service, also known as YaaS. So now you might ask, what is 𝗟𝗏? 𝗟𝗏 is a Solana native protocol that offers investor access to physical gold in digital form. So you can buy the gold token on Solana, which is backed 1 by 1 by physical gold, and generates a little bit of yield, 3 to 4% on top. So the TLDR, gold liquidity reimagined. And here is how it works. So the gold token, which is again backed 100% by physical gold, is put into a liquidity pool together with USDv, the native stablecoin of Solomon, rather than USDC. And here the beauty is, as 𝗟𝗏 explains, for the first time, the cash leg is earning 10% API inside the liquidity pool. So imagine if here was USDC, that's just the standard liquidity pool, and usually liquidity providers, they earn swap fees every time somebody swaps in and out of this pool, either buying gold, putting in stablecoins, or the other way around, selling gold, putting out stablecoins. And you pay a little fee to access this pool, and that's how liquidity providers generate revenue. But now, by simply holding USDv, you can earn additional 10% API on your holdings. And here is a step-by-step process of how this works. So again, here we have the liquidity pool, USDv, and gold. Then you, as a liquidity provider, you opt into YaaS, And then the YaaS program reads your USDv exposure and then streams yields directly into the liquidity provider's wallet. And if you might ask, where are the yields coming from? Mainly from stablecoin holdings, but also from delta neutral strategies similar to Ethena. And the key benefit here, as I explained above, is that liquidity providers have now two sources of income. First, the swap fees, and second, USDv rewards that are directly forwarded to their wallets. And this just leads to higher capital efficiency and benefits investors or traders like us. Here are some stats of the liquidity pool. We see that it has a cumulative volume of 1.2 million, and it already generated $2,150 for liquidity providers. So liquidity provider fees just from the swap volume is 16.23%, and if you then add the YaaS rewards on top, that's like an additional 5.83% of yield. And of course, this is highly beneficial for liquidity providers, and over time, more and more liquidity providers will opt into USDv as their stable leg for liquidity pools. USDv or die. So here with this image, I'm trying to explain you the concept behind yield as a service and how it works, and why I think that eventually all the liquidity providers have to adopt to this new model or die. So on the left side, we have the standard liquidity pool. We have a token, in this case it's gold, it can be Bitcoin, Solomon, Solana, whatever, which is paired usually with a stablecoin, in this case USDC. And liquidity providers, they put 50% of gold, 50% of USDC into this pool, and then they usually earn 0.2% in swap fees. Now here is where liquidity with USDv or YaaS comes into play. Same principle, liquidity pool consisting of two pairs, gold and a stablecoin, in this case USDv, and we have 0.2% swap fees. But now here, the key innovation is that 50% of the pool, which is called like the stablecoin leg, is now earning additional 11% API on top of the 0.2% swap fees. And this then, of course, benefits the liquidity providers because they earn more overall yield. So they can then, in a second step, lower the fees for this pool. So instead of charging 0.2, they can charge 0.175, attracting even more volume to this pool, routing more swaps through the pool, and hence they're generating even more yield. And eventually others, they have to adopt, or they will simply die, because all the users, they will automatically migrate over here because the swap fee that they are paying to buy gold is smaller than here in this pool, while liquidity providers are earning more money because here the stablecoin leg is earning as well, and just this pool routes more volume through it because the swap fees are lower. So just pause the video if it was too complex, or play it back, but this is a super key concept to understand. And the proof is in the pudding. Here we have some on-chain data, the gold USDC pool against the gold USDv pool. And of course here the TVL, total value lock, is higher for the USDC pool. But if we look here at the volume, despite here the TVL being 5x, the volume is just 2.5x. And most importantly, look here at the fees generated for LPs. LPs in the USDv pool are earning 3 times as much. And here is a comment that I wanted to share with you that 𝗟𝗲𝗿 made in the recent Labs update. He said, we also saw demand from users who wanted to add positions specifically to access YaaS. We are still gated, but open access is coming soon. So as of now, here, access to this pool is gated to the Aura protocol and a few other select users, because the supply of USDv is only 3 million as of now, but soon they will open the gates and increase the supply so that everybody out there can play around with YaaS. And then he continued, we expected to ship 2 more YaaS integrations last month, but partners' timelines slipped. Both are still in motion and should land shortly. So this clearly states that there is more demand for YaaS and more integrations should go live soon. And here he shared a dashboard of the YaaS platform and how it looks. So liquidity providers or single users, they can go to their YaaS dashboard, and over here you see the Meteora pool consisting of gold and USDv. So you connect your wallet, I suppose, and then it automatically shows you your positions, and then you can just click on opt into, and you start earning yield over here. And the beauty of YaaS is that there are no vaults involved. You don't have to use any wrapper tokens, and you don't have to stake your LP tokens either. Because YaaS abstracts yield routing, and as we've seen here in this example, this 𝗪𝗕𝗏 pool, LPs get rewards streamed straight to their wallet, and yeah, that's all they have to do. They once come to the YaaS platform, they opt into the service, and then the yield is simply streamed forward to them on a daily basis. But YaaS goes beyond just LPing, as we have seen here. Another use case for YaaS are neobanks. They can also opt into this servers, and now neobank users, they can hold stablecoins in form of USDv and earn passive yield by default. They can just hold the stablecoin. It is 100% spendable at any time, but as long as they hold it in their wallet or on their bank account, they earn passive yield on their stablecoins, which is super neat if you ask me. And then a third use case of YaaS are treasuries. As we all know, there are big crypto treasuries out there. And yeah, sometimes these treasuries, they just sit idle. They are not really actively being used, and they just bleed due to inflation. But now they can opt into YaaS, convert the USDC into USDv, and earn passive yield, by doing so extending the runway of the team. Talking about treasuries and how these big money sinks can be used to earn additional yield for the protocol, Solomon is preparing a proposal to convert their own project treasury from USDC into USDv. So first off, they're doing it to deepen the USDv USDC liquidity pool out there, since as of now there are only 3 million USDv circulating, and they just need this big liquidity pool for traders to trade in and out of USDv. And this was always their plan, as they highlighted it at their initial ICO, that part of the money that they raised, in total $8 million, will be used to convert into USDv, so that their treasury earns passive yield, extending the runway, but also deepening this liquidity pool. And this move, converting their treasury from USDC into USDv, establishes a legal and technical framework for other DAOs to easily follow. So I expect many other DAOs to follow suit once this proposal goes through in a flawless manner. And as we know, Solomon is a ownership coin token launched on MetaDAO. So yeah, I expect others like Meta, Avicii, Umbra to also convert parts of their treasury into USDv, just to extend the runway and earn additional yield on their treasury holdings. But YaaS can be extended even more beyond ownership coins. So every other DeFi protocol out there should be able to opt into YaaS as well. And super excitingly, we had 𝗪𝗂 announcing that their VC-funded startups can now choose to receive their funding in stablecoins. And this is just the best solution out there, because stablecoins and on-chain treasuries are just so much more flexible than traditional bank accounts. They can earn yield. Salaries are instant and global to near zero fees, so it's super straightforward to pay out salaries to contributing team members. And also, treasury management becomes much more feasible. As we know, most of the times, throughout the weekend, you want to do some transfers, but your banks are closed. So this resolves a lot of friction points. And then Renga here commented, this is the ideal use case for YaaS. You just hold stablecoins in your treasury, and the yield will be streamed automatically to your wallet, extending the runway of every single project. So I mean, if 𝗪𝗂 Combinator startups opted into YaaS, that would be a massive win for Solomon. But YaaS goes even one step beyond and is becoming this generalized yield engine, or the yield rails for DeFi, as I mentioned in the introduction. And this is another screenshot from the recent Labs update. And here, Renga said, the thing that I'm most excited about is that YaaS is a generalized rail, not a USDv only feature. And over the next 6 months, they're trying to push into other use cases beyond USDv, like YaaS being adapted for yield-bearing assets beyond USDv. Think of liquid staking tokens or any other yield instruments out there in the DeFi world. Furthermore, YaaS being used by major stablecoin issuers like Circle or Tether. I mean, the competition in the stablecoin space is super fierce, and there are two big players like USDv and Tether. So yeah, YaaS might be another approach for the Solomon team to get into the game, if they're not able to compete with USDv, that will most likely remain a niche product, but they can offer their infrastructure to bigger players to route yield to their users, since under the current regulatory regime, stablecoin issuers are not allowed to forward yield, but via YaaS, this can somehow be avoided, or it might be a way around. So yeah, long term, YaaS might be a massive revenue generator for Solomon. And then they are thinking about expanding YaaS to willing to support even more novel applications like liquidity incentives and distribution. But yeah, more on this later. So I thought about what can YaaS be used other than the current use cases. And another use case that I came up with is using YaaS for self-repaying collateral. Think about Camino or other lending protocols where you deposit stablecoins to borrow against. So yeah, let's say you deposit $1,000 worth of stablecoins to lend or to borrow $100 worth of Bitcoin, Solana, whatever. But eventually you have to repay what you borrowed. But now if this collateral is USDv, which earns yield passively, you probably don't even have to repay your loan because the collateral repays itself, which is super cool. Or think about perps exchanges like Hyperliquid, where you can use USDv to offset funding rates. So for those of you that are not familiar with funding rates, if you play around with perps and you go long or short a coin, either the long or the shorts are paying each other, and there is either a positive or a negative funding rate. So if you go long Bitcoin, there's usually a positive funding rate, so you have to pay to be long. But if your collateral is USDv, then yeah, it can offset these costs. And talking about incentives or distribution, think about programmable incentives, because YaaS can read the blockchain. So users that are actively liquidity providing, that are holding your token, or users that are staking for an extended period of time, you can then incentivize these folks by giving them an airdrop or early access to new product launches. So yeah, that's another use case I can think of if YaaS evolves over the months and years. Here we have another piece of alpha that Renga dropped in the Solomon Discord that I wanted to share with you here, guys. So he basically says that YaaS is becoming more and more of an infrastructure play, and he thinks that a lot of revenue will come from YaaS as an infra play going forward. Think of white label for other projects or apps that want productive by default coins without having to rebuild the entire stack. So that becomes really important, especially as institutions are entering the market. And he thinks that fees should compound fastest there, potentially even faster than USDv alone. And the team's goal is to generate revenue for non-USDv YaaS use cases within the next few months. And I personally think this is a very clever and smart strategy. Rather than competing with these big players and institutions, why not collaborate with them and offer them your infrastructure that you have already built out and is battle tested, and then just take a cut out of it. So they are doing all the distribution and you're delivering the technical know-how, and they're earning money this way. So yeah, I personally think that by the end of the year, they might actually be able to generate more fees by using YaaS as an infrastructure play than money coming from their own stablecoin. But yeah, let's see. I'm curious, what do you guys think? Let me know in the comments below which way they should go and makes more business sense. Switching gears, now let's talk about the Solomon buyback proposal that was hinted at by the team in the recent Labs note. So as some of you might know, the Solomon token is currently trading below NAV, which stands for net asset value. And if the coin is trading below the net asset value, this just means that the Solomon token is currently trading at a discount to the Treasury holdings. So this sounds weird, but yeah, in the current bear market, that's what happens. And those are the times where massive opportunities arise for investors, but also for teams, because you can now buy the token at a discount of the treasury value. And if you just take a step back and think about it, you can now buy into Solo. It's an ownership coin, which grants you full ownership over the IP, the treasury, and all future cash flows. And you buy this project below the USDC value that they're holding in their treasury. And so you're basically not even paying 1 single cent for the entire yield as a service infrastructure that they have been building out over the past months and years. Of course, there's always a risk involved, but this represents some asymmetric bets, if you ask me, very limited downside and massive upside if the team is able to execute. And the first step is that they are now taking advantage of this current situation, using some of their treasury to buy back their own token to just get rid or to buy out those short-term non-value add investors that are just constantly complaining about why does the token not bump, when do we upgrade the protocol, when next lab announcement, etc. So they're buying out all these short-sighted individuals, building up a treasury of solo tokens on top of USDC, which can then be used in the long term to better align investors or driving growth and bringing new incentives to the protocol over time. So one use case which they could then do later down the road with these acquired Solomon tokens is to bring in better aligned long-term capital or just external investors, because currently with all the projects that are launching on MetaDAO, eventually if they're not cash flow positive or if they want to raise more money to do even bigger things, they can mint new coins in their treasury and sell them then to the open market or to investors. Of course, this must always be approved by governments and go through 𝗬𝗪. But now, if they're buying these tokens down here, they no longer have to mint them later on, but they can just simply sell them from the treasury at a higher price at which they bought it as of now. Another option is, of course, to power incentives whenever they are ready. Let's say another product goes live, then they can give out Solomon tokens to bootstrap adoption or to just reward early users, or to establish a healthier secondary market, engaging with market makers or centralized exchanges. Now that we have some Solomon tokens in the treasury, we can give them via a loan to market makers to make markets on centralized exchanges or other DEXs. And that's everything we know thus far, and more details will be shared in their forthcoming proposal. But if you ask me, this makes a lot of sense. It helps to push the token back up to NAV. We are getting rid of all the short-term token holders, and we can create new compelling incentives going forward. So I'm curious to see what the final proposal will look like, but I'm super excited for this to go live. And wrapping up this presentation, let me shortly share with you what the team told us about their roadmap and the things they are currently working on and should go live over the next 6 to 8 months. The first major milestone is the legal compliance roadblock to be cleared to finally open up full access to YaaS and to lift the caps so that more people can be onboarded and use the protocol frictionlessly. Moving on, more integrations across the Solana ecosystem with other players are on the horizon, similar to 𝗪𝗏. Other projects are interested to tap into YaaS and just make more out of their liquidity positions. Another key milestone on their roadmap is to convert more liquidity providers out there from USDC into USDv. The team said that there is high demand out there, but before they have to overcome these regular obstacles to fully open up the liquidity pools and for USDv and make it permissionlessly acceptable, and then liquidity providers, professional players providing liquidity in the Solana ecosystem can start to swap their LP sites from USDC sold to USDv sold, whatever. Then, of course, we have treasuries opting into YaaS to extend their revenue and just earn additional yield on their idle assets. First off, Solomon will do the conversion, and then other established companies and treasuries will be converting into USDv and leveraging YaaS to benefit their treasuries. Then we have neobanks coming online and opting into YaaS, doing so providing better services to their customers by making them earn money on their stablecoins that are just sitting in their bank accounts. 𝗪𝗏 is one neobank that already announced that they're opting into YaaS. And then moreover, we have vaults that are also adopting USDv as their core building block. Think of lending protocols like Camino, or also perps, DEXs that are playing around with vaults. And arguably, their #1 priority or their North Star is to deepen liquidity for USDv. Because once the USDv liquidity is deep and real distribution has been achieved, and people out there are confident in opting into YaaS as it has proven itself, each new partner gets easier than the latest to integrate, and then this entire liquidity engine can start to spin so much faster. So yeah, that's again the roadmap. A lot of exciting milestones ahead. And yeah, I'm really looking forward how this will all play out. That's it for today, guys. Thanks for watching. I hope you found some value in this video. And if you did, please make sure to smash the like button and subscribe to this channel to support myself and everything I'm doing with on-chain trenches. And if you would like to get a closer look behind the scenes, get early access to these videos and my personal research, my personal portfolio holding, then yeah, waste no time. We have currently a special offer going for new members in on-chain trenches. Plus, we reduced the prices by 75%. So a membership now only costs $9 a month. And yeah, the caps are limited. The moment we hit 50 active members, we will double the prices. That's it, guys. See you in the on-chain trenches.